Hey, welcome back. In the last video, episode 1 of our Math for Finance crash course, we talked about optimization, curve fitting, and the Taylor polynomial. If you missed that one, kindly watch that first to have an appreciation of the Taylor polynomial. That's because today, we'll focus on its application, especially for investment management and risk management of bond portfolios, namely via bond duration. So, in this video, we will discuss the time value of money and basic interest rate theory. We'll discuss bond pricing and basic market conventions. And then we'll discuss how to use the Taylor polynomial to estimate the changes in bond prices given changes in yields, with a focus on bond duration for investment management and risk management. To start off, well, obviously, money has time value, and 1,000 today should be worth more in a year's time. Unless, of course, you're in a negative inflationary environment where prices are coming down. If you invest 1,000 now and it becomes 1,100, well, one way to think of this is that you earn a return of 10%, meaning 1,100 divided by 1,000 minus 1. Now we'll talk about simple versus compound interest rates. We need to take a look at the investment instruments and see what they say about how interest is credited, whether it's going to be simple interest or compound interest. And this is especially true for fixed income instruments rather than investments with no guaranteed yields. So let's take a look at what the numbers might look like across 1 year for simple interest versus compound interest rates. Notice that here, both will hit 1,100 in a year's time. But before that, simple interest gives higher amounts than annual compounding in this example. So how crediting is going to be done is important. But for today's lessons, we won't deep dive into the different ways interest rates can be expressed in terms of simple interest or periodic compounding, which really deserves its own video. For now, we will focus on annual compounding, meaning interest is earned every year, and any interest earned will also accrue interest as we move forward, the very definition of compounding. So we'll focus on bonds, and the focus will be on annual cash flows and annual compounding to simplify the discussions. Future value versus present value. When we accumulate funds, we let the amount compound and earn interest rate. For example, 1,000 times 1 plus 10% is equal to 1,100. And we can reverse the process and get the present value by discounting. And discounting here means the reverse process of accumulating. So if 1,000 times 1 plus I is equal to 1,100, then 1,100 divided by 1 plus I should be equal to 1,000. Or we also write that down as 1,100 times 1 plus I raised to the power negative 1 is equal to 1,000. So this is really just the reverse process of accumulating. Now, what is a bond? Well, a bond can be thought of as nothing more but a set of future cash flows. And here we're going to talk about plain vanilla bonds with periodic coupon payments and a par value at maturity. So here we have these cash flows, the coupons, and here in this example, there's an annual coupon of $100, and then at the end of 5 years, there's going to be the last coupon payment plus the par value of 1,000 being paid out. Here, the par value is 1,000 and the coupon is 100 annually, or 10% of par value. Now, the price of the bond is nothing more but the present value of all the cash flows at an interest rate. And therefore, we just take a look at each cash flow and get the present value, or we discount them to the present. And that's the price. For example, for an annual coupon of 5%, a 2-year bond with par value of 1,000, it will be priced like this. So the first cash flow is 50, get the present value at 8% because the given is an interest rate of 8% over here. You got 46.30, and then the second year's cash flow at 1,050, you get the present value of that for 2 years, and therefore we get this 946.51. Now, it's actually easier to work this via spreadsheets, and we'll provide the spreadsheets, and just check out the video description below. Now, what happens if the interest rate is 5%, all things being equal? You'll notice that if the interest rate for discounting is 5% and the coupon is also 5%, then the present value is exactly the par value. So previously, we had pricing at the discount to par value because the price is lower than par value. Here, the price is equal to par value. So one simply says it's priced at par. Now, what happens if the interest rate is equal to 3% and the same given as before? You'll notice that the price will now be bigger than par. So we say that the bond is priced at a premium to par value. What are the takeaways from that quick discussion? Well, if the interest rate is equal to the coupon rate, the bond will be priced at par value. If the interest rate is greater than the coupon rate, the bond will be priced at a discount to par value. Now try to think of this as the coupon not being enough to offset the yields required. So the price of the bond should be reduced to give additional yield to the buyer. After all, the coupons are not paying enough. Therefore, you have to get that additional yield from a lower price. What about if the interest rate is less than the coupon rate? Now the bond will be priced at a premium to par value. In this case, the coupon is too big versus the yields. Therefore, it's very attractive and you're going to get more in terms of the coupon than what current yields might give. Therefore, higher price so that it will offset the bigger coupons that are paid out by this bond. So there are no free lunches really. Okay, now let's move on to zero coupon bonds. What are zero coupon bonds? These are bonds that don't pay out any coupons, so only the par value is paid out at maturity. We will focus on this one because it's more tractable to discussions, although we will extend this to more plain vanilla bonds. So what would be the price of a par value 1000? Well, the price will simply be 1000 times 1 plus I raised to the tenor of the bond, or the time to maturity of the bond. For example, a zero coupon bond with a tenor of 10 years at 8% discount at a par value of 1000, it's going to be this one, 463.19. And you'll notice that it's at a deep discount versus par. Now, based on this one, let's go back to the Taylor polynomial and let's review that quick formula over here as shown. Now, let's discuss this in terms of the zero coupon bonds. One way to think about that Taylor polynomial is that P of x is the new price, f of I is the price at current interest rate I, and then you have the first derivative and second derivatives times delta x's. So one way to think about that is that the new price is equal to the old price plus certain adjustments due to curvature. Now, let's put f of I in the other side. So we're going to have p of x minus f of I is equal to this thing on the right side, which is the first and second derivatives times their delta x's. Now, if we divide both sides by f of I, then we're going to have p of x minus f of I all over f of I. Since p of x is the new price and f of I is the old price, then this is really the new price minus the old price all over the old price, which just gives you the return or the percentage movement. And we're going to discuss, therefore, this percentage movement in terms of the first and second derivatives times the delta x's. If we take a look at f prime of I all over f of I, it'll have a special name called duration, and f double prime of I all over f of I, don't forget the 1/2, that's going to be your convexity adjustment. Now, the percentage change therefore can be expressed as negative duration times delta x plus convexity times delta x squared. Now, let's take a look at the actual price function of the zero coupon bond. So p of x is equal to 1000 times 1 plus x raised to the power negative 10. Then the first derivative is going to be 1000 times negative 10 times 1 plus x raised to the power negative 11. Remember that if you're getting f of x is equal to x raised to the power 10, then the first derivative is going to be 10x raised to the power 9. So the power will go down and then you subtract 1 from the exponent. And that's why we have this number over here. Now, if we get p prime of x divided by p of x, then we're going to get this number. We're going to expand this so that we can cancel the numerators and denominators, and we'll be left with negative 10, which is the tenor, divided by 1 plus x. If we take the absolute value of this number, that's what we call modified duration. So this is modified duration, and it's got something to do with the cash flows. So some remarks. Since the exponent is a negative integer, the first derivative is always going to be negative. But duration is always treated as a positive number. So therefore, we need to adjust the formula accordingly. That's why we have the negative duration times delta x, because we don't talk about negative duration. We just have duration, which is a positive number. So we need to append that negative number times delta x. Okay, so the percentage change therefore will be negative duration times delta x plus convexity times the delta x squared. Now the duration has always something to do with the timing of the cash flows. With our previous zero coupon bond example, the modified duration is 10 all over 1 plus x. If we ignore the discount factor, meaning the 1 plus x, then this becomes the Macaulay duration, which is exactly 10. Also, given the negative slope, there is an inverse relationship between price and yields. As yields go up, the price goes down, and as yields go down, the price goes up. So going back to our zero coupon bond, this table is going to need some explanation. So we're currently at 8%, and we're going to take a look at movements of interest rates away from 8%, moving perhaps to 6% or to 10%. And we have here the actual prices as computed via the spreadsheet. Now, we're going to take a look at the percentage change of the price as you move away from 8%. So for example, the 20.6% actual change is 558.39 all over 463.19 minus 1. So interest rates are coming down from 8% to 6%, and therefore prices will go up, and will go up by 20.6. And vice versa, if interest rates are going up, you'll notice that prices are coming down, and the actual change over here would be negative 16.8% for a 2 percentage point increase in interest rates. So it's going to be 385.54 all over 463.19 minus 1, which gives you your negative 16.8. Now we've added an additional column over here, the delta x, which is just really the change away from our point of origin, 8%. That's why the delta x there is negative 2%, negative 1%, 0, and 1 and 2%. Now, what's going to be the estimated percentage change if we just take a look at duration? The modified duration times delta x will give you 18.5%, 9.3%, negative 9.3%, and negative 18.5%. So you'll notice that the estimated percentage change is a linear function, unlike the real change in the prices of the bonds. This is because duration is a linear concept, and upwards and downwards movement are all the same to it. So the modified duration here is 9.2592, etc., times delta x, and you're going to have these numbers. So you'll notice that the numbers are off by bigger amounts the bigger the change in yields versus the actual changes. This happens because duration is linear, like we said a while ago, while the actual price curve is non-linear. So therefore, we have this graph over here with the estimated price given by duration and then the delta excess away from I. So you're going to have that error over there. This means that in order to accommodate large changes in X where curvature is going to be important, you need to take a look at the curvature numbers, which is given by the convexity. Therefore, we need to take a look at not just the first derivative, but also the second derivative. So consider the second derivative of X divided by the price. Then let's not forget the 1/2 because that's part of the Taylor polynomial. And you're going to have this number. And this is going to be called the convexity adjustment, and it's always positive. So it's got something to do still with the timing of the cash flow or the tenor of the cash flow, but you have this additional t plus 1 because we're now taking a look at the second derivative. Okay, so you can pause this so that you can take a look at how the numbers look like, and then just play on once you're done. So going back to our table, we need to adjust for curvature. So our convexity adjustment is over here, 47.15. Then we multiply that convexity adjustment by delta x squared. We're going to have this additional column, which we add to our original delta x. Now this time, if we add both md times delta x plus ca times delta x squared, our estimated change is now closer to the actual change. For example, 20.6 versus 20.4% when yields go down by 2%. Or it's negative 16.8% if interest rates move up by 2 percentage points. And the estimate is negative 16.6%. So it's quite close, and therefore the convexity adjustment is quite useful, especially for big changes in interest rates. Therefore, your estimated change in price as yields move to X from I is really given by this formula over here. Now, for most cases, interest rates move by small increments, so duration should already be a good approximation of the percentage change. For example, if you have a bond portfolio of 100 million with a modified duration of 6, for example, then the estimated change in the value of your portfolio is this one. Negative 6 times delta x, or negative 6%, and therefore your new portfolio value is expected to be 94 million from 100 million if interest rates move up by this amount. And if interest rates move down by 1%, then this becomes negative 6 times negative 1% is equal to positive 6%. So your new portfolio value should be 106, or 100 million times 1 plus 6%. So that's how duration is used. Now, the formulas are generally applicable. They're not merely for zero coupon bonds, but they apply as well to plain vanilla bonds. And therefore, let's talk about the plain vanilla bond with coupon of 10%, par value of 1,000 with annual coupons and a maturity of 5 years. We can write this down in summation formula, and we note that the derivative of a sum is simply the sum of the derivatives. Therefore, we can simply just take a look at P prime is equal to the cash flow times negative t times t plus 1 raised to the power negative t minus 1. And then the second derivative will be the summation of the cash flows times negative t minus 1 times 1 plus I raised to the power negative t minus 2. So they still talk about the timing of the cash flows, and for the first derivative, the multiplier will be negative t, and for the second derivative, the multiplier will always be t times t plus 1. But don't forget the 1 plus I raised to the power negative 1 for the first derivative, and 1 plus I raised to the power negative 2 for the second derivative. This is actually easier to work using spreadsheets. So given a spreadsheet, this is what's going to look like, and therefore we have this cash flows over here. Then we have the present value factors, meaning 1 plus 8% raised to the power negative t. Therefore, you have your present value factor. You can get, therefore, the present value of the cash flows, which is this third column over here, or which is this column over here named present value. And you'll notice that the price is 1,079, and this is because the coupons are rather large versus the discount rate, and therefore this is priced at a premium. Now t times present value, we need that to compute for the duration, and here t times present value, if we sum it all up, it's going to be 4,539.43. Therefore, if we divide that by the price, you're going to have the Macaulay and modified duration like so. And please kindly take a look at the spreadsheets we're sharing so that you can see how this formulation is done. The point here is that once you do this, your estimated change in the price is going to be 7.78% negative for the duration, but the actual change is negative 7.39%. So if we add the convexity adjustment like so, then our estimated change is going to be negative 7.38%. And we see that therefore that with both duration and convexity, it does really a good job of approximating or estimating the percentage change in the price of your fixed income portfolios when interest rates move. Now, how do we remember duration? Try to think of the timing of the cash flow so that you can internalize the definition of duration. So it's some sort of weighted average of the timing of the cash flows, where the weights are represented by the present value of the cash flows. So here's a graph. Imagine a fulcrum where the center of gravity is. That fulcrum where all of the present values will balance out is the duration. So one way to think about duration is try to think about the weighted average of the time to maturity of the cash flows. Now, duration in practice. What happens if interest rates are going up? Would you prefer high duration or low durations? As an answer, if interest rates are going up, we know that the value of the bonds will come down. Therefore, you might want to reduce your duration so that the bond prices will not go down that much. So you might want to reduce duration to lessen the loss of value of your bonds. By the way, this is only true for your trading portfolios, and it's not true for assets that are being held to maturity. This is really more for your trading portfolio. Therefore, if you knew how your bond portfolio will move based on where interest rates are going, then how do you actually change your duration? So remembering that duration has something to do with the timing of the cash flows. So to increase duration, you might want to sell your shorter bonds then go for longer bonds. Or if you wanted to decrease your duration, you might want to do the reverse and sell your longer bonds and go for shorter bonds. Note, however, that buying and selling will cost you money, and it's not clear if it's worth doing if the yields are only moving up and down by small increments. Therefore, it's really best to do scenario analysis and also take a look not just at trading costs but execution risks as well. So defining duration, while it's true that duration has something to do with the timing of the cash flows, it's really a measure of interest rate sensitivity of your fixed income portfolio. The higher the duration, the more interest rate sensitive your trading portfolio is, and vice versa. One last note, while it's good to remember duration as some sort of average time to maturity of the cash flows, don't ever say that to your clients. Don't say it's the average time to maturity, because they're going to think that, so the maturity is shorter and therefore I'm going to get my money sooner. No, cash flow still happens during the payment period, and therefore, while it's a good way to remember duration, it sends the wrong message. So just call duration the sensitivity of your bond portfolio to interest rate movements. And that's all that we have for today. Please like and subscribe to support the channel. See you next time.